Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic with us as economic profit. Now, see, economic profit is basically, if you see, economic profit is basically the difference, a difference between what? Okay, it is a difference between the accounting profit and the opportunity cost. Okay, let me write the accounting profit and the less the opportunity cost. Okay, now this opportunity cost is basically the cost that has been foregone by the business as business has invested into the existing project. Now, first, what is economic profit? Well, see, whenever a firm takes about profit, it's usually accounting profit. And accounting profit in simple terms is basically the difference. It is the difference between the total revenue and the explicit cost. This is the explicit cost the company is incurring. So now in the economic accounting profit, if it does not make any sense, because it does not ensure whether the business is making real profit or not, that is what we have to figure out. So that's the reason economists turn to economic profit. Now, economic profit is basically the difference between accounting profit and opportunity cost for the business that has been foregone, and as the business has invested in the existing project. So let's take economic profit example to understand this. Let's say there is a guy called Mr. A who has left his job to start a restaurant business. And Mr. A, he was, let's say, a lawyer. He was a lawyer, and he was making around 1 lakh per year, and he felt that he's more inclined towards food and fun, so he started this business. So he felt that he's more inclined towards food and fun, so he started this business where in the first year he has made an accounting profit of closely around, let's say, 50,000, and Mr. A has to forego his job as a lawyer and a salary which is basically your opportunity cost, that is, let's say, to the extent of 1 lakh. So even if he has made an accounting profit in his restaurant business, economically he has made an economic profit of how much? 50,000 less 1 lakh, that is minus 50,000. Right? See, as a rational decision maker, Mr. A keeps on earning an accounting profit of 50,000. And then going back to the job as a lawyer, he may seem to be the right decision. But if it is not negative, or it is less equal, he may choose restaurant business over his job as a lawyer. Okay, now let's discuss the next thing, that is the formula part. See, if you see the economic profit formula, that is equal to your accounting profit less the opportunity cost that has been foregone. So you may wonder what accounting profit is. Okay, see, accounting profit over here is equal to your total revenue less any sort of explicit cost. So in simple terms, when we call our firm has made a profit, we indicate that our firm has made an accounting profit. Remember this. Now, here's what is relevant here. The total revenue that you get is equal to your sale price. It is the sale price divided by the unit into the number of products that have been sold. So this was the total revenue. Now let's discuss the explicit costs that are involved in this. An explicit cost includes wages, rent, and then any equipment cost. Okay, equipment rent that you pay, plus electricity if you pay that, plus telephone expense, and finally the advertising expense. Okay, so every business has to incur some of the expenses that they need to pay out of their own pocket to keep the business running and to keep producing the product they would be selling. And these expenses are called nothing but the explicit costs. Okay, now let's look at the economic profit calculation. See, if you see the economic profit formula, that is basically the total revenue less the explicit cost, and you need to deduct also the opportunity cost that has been foregone. Okay. Now, this was the formula part that you must have got a clear idea. Well, hence, now we'll go to the interpretation part. See, it is why it is important, because it is based on the concept on called trade-off. See, let's take a simple example here to understand the concept of trade-off. Let's say you decide to read an article, and instead of playing a game on your mobile phone, here the same time could have been invested in different things, but you decided to invest your time into, let's say, in the article, and you can understand it. But let's take another example. Suppose after completing your graduation, you decided to go for, let's say, MBA instead of doing a full-time job. And now you have invested around, let's say, $60,000 in your MBA. And also, let's say, if you would have joined a job after graduation, you would have earned a decent of $40,000 per annum. So what would be your cost of MBA? Do you think it's 60,000? No. Answer is completely no. It would be the amount that have been foregone being employed by choosing to do MBA plus the cost of MBA. So here's what your MBA costs. How much? 60,000, right? Plus bracket 40,000 into 2 years, which you're going to spend. That's $1,40,000 that you are going to. And I have not even considered your increment part. So if you get a job after MBA, it's not more than 1,40,000. So you have incurred a loss doing the trade-off of choosing MBA over the full-time employment. Now think about the business. If a business only thinks about the profit they are making and not the trade-off of the business has made because of choosing to invest in one project and not the another one, so then it would not be an appropriate calculation. Like for example, let's say company MNP has invested, let's say closely around, let's say there is a company which has MNP which has invested closely around 1 lakh in the project G. Now they have foregone the opportunity to invest the same amount other project which might have yielded better return for the company MNP. So if you don't take the trade-off into account, you are actually doing the wrong calculation, right? You need to understand this very, very clear in your head. If you are not able to do this calculation well, you are actually going somewhere or the other wrong in this particular regard. Well, on the limitation part, there are some limitation to this also. See, even if it is used to take opportunity cost into account, it has some weakness, and we cannot ignore that. See, it is only applicable for a year time span. Now, if we calculate the last year profit, it does not always necessarily give any due advantage. Any value that is obtained by employees or the company is not considered to be the calculation. Remember that. Now, many economists mention that it is all that you need to have, depending on one or more metric, is not free from risk. So the investor should look at the bunch of the ratios along with the profit. So finally, after discussing all the elements, let me make my conclusion on this particular topic. See, there are two things that you need to consider. First is the accounting profit. And accounting profit is not always exhaustive. You need to think through the opportunity cost. Very important. As well as second, before investing into any new project or company, you need to look at the market at first and find out whether this is the best investment you are making it or not. So that should be very clear in your head. So that's it for this particular topic. I thank you everyone for joining the session. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you everyone. Cheers.